Good morning. This is Connor from 0DTE Traders here to present the week ahead for November 3rd, 2025. In this video, we'll cover S&P 500 gamma exposure, highlight some transitional levels. We'll talk about the VIX and end with mega caps. To start the week, GEX, which measures dealer gamma exposure, is positive, 340 million notional, trading above both transitional levels 68.20 flip and 67.45 gamma. The flip is our main transitional level. This is where dealer hedging shifts from stabilizing above to destabilizing below. And this is generally visible on the notional gamma chart via all strikes positive above, all strikes negative below, which you can see is mostly the case here today. So as long as we hold above that flip level, we remain in the buy the dip regime. Below the flip, we would anticipate elevated volatility and approach the dip buys with a little bit more caution. In regards to upside levels, 6,900 big gamma level, we have the all-time high at about 69.20, and then you got 25 is a bit of a gamma level, followed by 69.50 and then 7,000, which is technically the call wall. That is defined by the strike with the highest notional positive gamma. In other words, the largest green bar. Now, this may be a bit of a stretch here this week, given the 5-day implied move. But is a potential upside target, into year end, maybe sooner. Now, below that flip, 6,800 is still a pretty big level here. So you have 6,800 on the downside, 6,900 on the upside, and then perhaps a break one way or the other will tilt control a little bit more to one side. But this could very well be sort of boxing and price action here this week. Transitioning over to the SPX chart on the 1-hour time frame, the trend remains up, printing a series of higher lows with an upsloping trend line potentially in play this week as support or a break as a bearish indication. Now, exactly where this trend line comes into play is always a question mark, depends on time and velocity, but no, it's there. Now, recall we had that big breakout above 67.50 not too long ago. Big move higher led by mega caps. But we have peaked here last Wednesday, and we have been in a short-term downtrend. So if we go to the 15-minute time frame, we can see the SPX printing a series of lower highs and lower lows. Now, these are quite marginal, but this is a short-term downtrend in the context of a higher term uptrend with a trend line connecting that all-time high. So same logic here, potential resistance, and then a break as a bullish signal. I am recording this quite early. It's 5 o'clock Eastern time, but as of right now, it does look like equities are going to open on a positive note. SPY pre-market up about 0.4%, Qs up 0.6%, and IWM up 0.1%. Now, if we toggle on the 0DTE price model indicator, it will automatically plot our daily levels on your chart, including our transitional levels and the 1-day implied high and implied low. So we can see here the first resistance zone on the upside is 68.68 to 68.75. A break of that zone opens the door to a gap zone from 68.80 to 68.90, followed by the big 6,900 strike and the all-time high up here at about 69.20. As far as the downside goes, the first major support is going to be that flip level at 68.20. A break opens the door to a gap zone from 68.14 to 67.91 with a gamma level in here, the 6800 strike. So when we see something like this with a gap zone or a gap fill that sits just beyond a major level, what the market likes to do is come down and fill the gap, and then you get a little bit of a false break of that level. So in this sort of situation, it's generally best to treat it as a zone. Below that sits another gap zone from 67.79, fill 67.38, and very similar here, right? Because we have a gamma zone at 67.50, 67.45 gamma with that fill just below. So same sort of scenario here, potential for false breaks, and best to treat it as a zone. Now, in this range here, we have 68.50, which is a big gamma level marked as support or resistance. As we can see here, it hasn't been respected a whole lot. And this could be the case here again this week. with 6,900 as the upside, 6,800 as the downside. And then this would essentially be the mean of range. And, if a range starts to form, um, generally the mean is quite choppy. So we'll see how price behaves to 68.50 this week. But the big level on the upside, 6,900. If bulls can get a close above, firm control. Below 6,800. If bears can get a close below, firm control. Popping over to the weekly chart, I just want to highlight the weakening breadth. Since SPX broke out above 6150, which was more or less the all-time high before the sharp sell-off at the beginning of the year, the rally has been very narrow, led higher by growth, mega caps, the AI theme, while nothing else is really participating. Breadth down. So we're seeing bearish divergence in regards to breadth. Now, what we're looking at here is moving average participation, and it tracks the number of S&P 500 stocks trading above their 50 daily simple moving average. It is normalized on a 0 to 100 scale, where 100 means 100% of stocks are trading above their 50 daily moving average. 0% mean none are. The current reading is 40%. So this is pushing into bearish territory. The main thing here is if we start to see deterioration in the AI theme, in the mega caps, it will have a negative consequence in the S&P 500, particularly if we don't see meaningful rotation into other segments of the market, such as cyclicals and defensives. So I think what we really want to start to see here is that rotation trade start to pick up. Absent such, this market rally may be a little bit fragile. We don't usually comment on earnings as we're 0DTE traders, so our focus is on the price chart, our levels, our setups. But last week's earnings were quite interesting, particularly the divergence in the market reaction. So first and foremost, AI spending is massive and accelerating across the mega caps. However, participants are now becoming more selective, rewarding disciplined capex, such as Alphabet and Microsoft, and punishing perceived access, such as Meta, which was down, 10% post-earnings. So when we start to see diverging earnings reactions, it generally suggests a maturing cycle. In this case, the AI cycle, where execution and profitability matter more than headline investment. So the next phase likely hinges on whether AI investment produces visible returns before economic growth slows. Once again, if we start to see deterioration in the AI theme, we will have some very sharp intraday sell-offs. So we want to pay very close attention to growth MAGS. If they were holding up, advancing or trading flat, downside's going to be limited. But if they do start to get a sell-off, that's when we kind of want to step out of the way or be a lot more cautious on that dip buy trade. The VIX closed at 17.43 on Friday, above the open interest lower bound of 1615. 22 is a transitional strike above. All strikes become call dominant, meaning there are more calls than puts there. And that's essentially where you can start to expect vol to increase. With potential resistance, peak formations at 25-30, two very dominant call strikes. But in terms of implied volatility here this week, options are pricing in a relatively quiet week with a 1.7% implied move and a range of 67.24 on the downside and 69.56 on the upside. For the week ahead, the U.S. government remains in shutdown and the economic calendar is light, with the ISM PMI serving as the primary focus. ISM manufacturing PMI due out today at 10 o'clock. ISM services PMI due out at 10 o'clock on Wednesday. Earnings season is set to ramp up. Major names reporting include Palantir, AMD, Shopify, McDonald's, Qualcomm. Packed calendar, over 100 names reporting. Traders will also keep an eye on trade updates and remarks from Fed officials as they are back on the speaking circuit. If you're not a member and you want to get access to our daily metrics and levels and learn our process, join the team at 0DTEtraders.com.